Why is financial anxiety on the rise, and what does it mean for your investments?
That's a pressing question. Experts like Danielle DiMartino, Booth, and Mark Smith have the answers as they analyze market trends.
In just a few minutes, we will distill their comprehensive insights into key takeaways thanks to our AI-powered summaries.
Buckle up, because Danielle will start by unpacking how the MOVE Index reflects market volatility.
And stick around. Mark Smith dives deep into the drop in housing demand and its implications for buyers.
Remember, this is all for educational purposes, not investment advice.
Today, we are discussing insights from Danielle DiMartino Booth regarding the MOVE Index and its implications for various asset classes.
Danielle indicates how the MOVE Index can serve as a warning for upcoming market volatility.
Danielle DiMartino Booth highlights that the MOVE Index shows a rise in volatility, particularly impacting credit markets.
She warns that this surge in volatility could foreshadow widespread disruptions across various asset classes.
What are Danielle DiMartino Booth's views on the credit markets?
Danielle observes that widening credit spreads indicate rising risk perception, potentially leading to tighter lending conditions.
How does this volatility affect the stock markets, according to Danielle?
Danielle explains that increasing volatility makes equities vulnerable to sharp corrections, especially if investor sentiment shifts.
What is gold's role in the current market context?
According to Danielle, gold often acts as a defensive asset during periods of market upheaval.
What predictions does Danielle make for the market based on the MOVE Index?
Danielle foresees possible corrections in stock and credit markets alongside increased demand for gold as a safe haven.
In conclusion, how should investors adapt to potential market changes?
Danielle advises that diversifying portfolios is key in response to rising volatility.
She also emphasizes the importance of monitoring the MOVE Index for timely investment decisions. Today, we examine the recent analysis by Mark Smith regarding the significant drop in housing demand, which has recently reached a 30-year low.
Mark highlights that escalating interest rates are strongly contributing to this downturn, negatively impacting potential buyers in the market.
Mark Smith explains that the primary factor affecting housing demand is the surge in interest rates, making mortgages increasingly unaffordable.
Additionally, he discusses the role of economic uncertainty in discouraging potential homebuyers from entering the market. Mark emphasizes that skyrocketing mortgage rates are forcing many prospective buyers to reconsider their plans.
Essentially, people are finding it difficult to afford homes at these elevated rates. Mark points out that economic fluctuations are leading many to hesitate before making significant financial commitments.
This is evident in buyer sentiment, with many choosing to wait for clearer market signals before proceeding.
What does Mark predict for housing demand in the next few years?
Mark anticipates that demand could stabilize if interest rates begin to decline significantly, although this will depend heavily on the overall economic recovery.
Mark Smith concludes with takeaways for potential buyers. Keeping an eye on interest rates and preparing financially is crucial.
He also advises individuals to evaluate their readiness to purchase based on ongoing market changes.
Today, we explore an analysis by Emily Brown, shared during her discussion with David Lin, regarding potential challenges for equity markets.
Emily outlines significant support levels that are at risk of being breached, indicating that a pullback might be forthcoming.
Emily Brown identifies that current market conditions suggest a breakdown of key support levels.
According to David Lin, this perspective aligns with the trends observed in recent trading sessions.
What does Emily Brown say about the influence of rising yields on the markets?
Emily notes that as yields rise, borrowing costs increase, creating headwinds for equity valuations. Emily highlights that the current bearish patterns could indicate upcoming declines.
Indeed, David points out that investors should remain cautious as these patterns unfold. How does Emily describe the current investor sentiment?
Emily observes that many investors are moving into cash, signaling a hedge against expected volatility.
What does Emily Brown predict regarding the equity markets this year?
Emily forecasts a correction of 15 to 25%, with persistent volatility on the horizon.
Emily advises that investors keep a close eye on critical support levels and technical signals.
David also suggests monitoring economic indicators to assess market stability.
In today's discussion, we examine insights from Amazon's recent report on consumer behavior.
The analysis highlights how many Americans are adjusting their spending in response to economic factors.
According to Amazon's report, the current economic challenges are leading Americans to rethink their spending priorities.
The analysis reveals that inflation has pushed consumers to favor essentials over luxury products. The report indicates that rising inflation is making consumers more price-sensitive.
Consequently, they are more likely to seek discounts and consider lower-priced alternatives. The analysis points to a significant trend toward budget-friendly options.
This shift indicates that brands must adapt to the evolving consumer landscape. Interestingly, the report emphasizes a rise in online shopping as consumers look for competitive pricing.
This shift highlights the importance of convenience in today's consumer choices. Experts foresee that persistent inflation will lead to deeper changes in consumer spending.
Brands will need to navigate this shifting environment to effectively reach budget-conscious shoppers.
In conclusion, Amazon's report underscores the necessity for businesses to adapt to changing consumer stresses.
Companies may need to reassess their product lines to align better with evolving consumer priorities, focusing on affordability and value.
Today, we explore insights from the technical traders regarding the critical distinctions between market cycle stages.
Their presentation highlights the implications these stages have for investor behavior.
The technical traders emphasize that understanding the nuances of each stage can critically impact investment strategies.
Recognizing which stage we are in is paramount for effective trading.
How does the technical traders differentiate between Stage 1 and Stage 3?
According to the technical traders, Stage 1 shows confident accumulation among investors.
Stage 3, in contrast, sees increased caution as investors begin profit-taking.
What outlook do the technical traders provide based on the current market stage?
If we are in Stage 1, positive trends may continue.
Conversely, if we are in Stage 3, investors need to be cautious of rapid market changes.
The technical traders recommend that investors monitor market indicators closely to assess changes.
They advocate for flexible trading strategies that adapt to market shifts.
Understanding these dynamics can enhance decision-making and risk management significantly. In this episode, we dive into financial issues many families are facing with insights from Emily Turner, who discusses how daycare expenses now often exceed mortgage payments.
Emily underscores the significant impact on family finances and the urgent need for effective budgeting.
Emily Turner highlights that daycare expenses have surged to surpass mortgage costs for many families.
This dramatic shift creates significant pressure on household budgets, forcing many families to reassess their financial priorities. Emily Turner clarifies that daycare services can take a significant portion of household budgets, placing families under stress.
That seems extremely challenging. What are the strategies families are using to address these costs?
Emily stresses the importance of effective budgeting during these financially taxing times.
Numerous families are compelled to reevaluate their spending habits to adapt.
What predictions does Emily offer regarding the challenges families will face moving forward?
Emily expects that financial strains will continue, putting more families in search of alternative childcare options.
Emily concludes with recommendations for families to access community resources for assistance in managing rising costs.
Using budgeting tools effectively can aid in prioritizing expenses as financial demands grow.
Finally, considering cooperative childcare options could be a strategic alternative for families under financial stress. Wow, we've really unpacked a wealth of insights today.
Absolutely. Each guest brought something unique to the table. Emily Turner highlighted the real struggles with daycare costs outpacing housing.
And that's a shocking reality for families. And then we heard from the technical traders digging into the market cycles.
Right, the distinction between Stage 1 and Stage 3 is crucial for traders. Such a practical take.
And Amazon's insights about changing consumer behavior. That shows just how interconnected these factors are.
Indeed, and let's not overlook Emily Brown's warning about rising yields and potential market pullbacks.
So the potential for volatility is high, especially when paired with Mark Smith's insights on housing demand.
All these differing views illuminate just how complex our financial landscape has become.
If you found today's discussion valuable, don't forget to like and subscribe.
Your support goes a long way in helping us bring more expert analyses straight to you.
Next time, we'll dive even deeper into market dynamics. It's going to be a must-watch.
Thanks for watching, and we'll see you in the next one.